Hey, entrepreneurs, are you trying to make bigger profits in your small business? If you're like most of us entrepreneurs, increasing your profitability is always on your mind. And you're probably looking for ways to increase your revenue while growing your company. Well, you found the right podcast that shares ideas that'll help you do just that. I'm Marcia. I'm a business growth strategist, and I've helped tons of small business owners to establish and implement a tangible plan that guarantees increased profitability, guides your growth, and plans for your future exit. Building a highly profitable and sale-ready business creates a win-win scenario. That's more money now and a windfall later when it's time to let go. I want to share strategies that I've learned with you on today's Profit with a Plan podcast. But before we get started, I have some great news for you. I've released my second book called The Profit Accelerator, and I'm looking for a few industry leaders and business owners to interview about how my book's 12 strategies would impact your industry. Go download my book and let me know if you want to be interviewed. It's available for free for the next few weeks while I'm interviewing business owners. So confident that this book and their strategies can help any business increase their revenue, profit, and the value of their company without having to pay for additional advertising or marketing. Go pick up your book at www.trajectoryprofits.com/book-download. All right, listeners, I'm really excited to have with you today my international guest, Melissa Widner is the CEO of Lighter Capital, the pioneer and leader in revenue-based financing for tech startups and scale-ups. Lighter Capital is backed by the National Australia Bank, Silicon Valley Bank, and Voyager Capital. Melissa has a deep understanding of both entrepreneurial's journey and the role a funding partner can provide. As CEO, Melissa has led 2 companies to successful exits, returning over 10 times the return to her investors. She was the founder and CEO of a Silicon Valley-based 7 Software, which was acquired by one company, CNQR, then acquired by SAP. We're talking serious here, folks. She was the managing director of NAV Ventures, the VC arm of National Australia Bank, where she led the bank's investments into high-growth fintechs, including Lighter Capital. Melissa holds a master's degree from Stanford University and a bachelor's degree from the University of Washington. Melissa, thank you so much for coming on the show. Welcome to Profit with a Plan podcast.
Hi, Marcia. Thanks for having me. It's great to be here.
Absolutely. I love this. And this is such an important time for businesses to be looking at financing and financing available to them at a time where maybe, at least in the States here, we're going into a recessionary kind of period and into a new year. This is a perfect topic to get going on. But let me ask you a question. And I ask everybody this question: what in the world was so attractive to corporate financing for you to come into this world?
To Lighter Capital specifically. So I've been around the startup financing world for almost a couple decades now. And Lighter Capital to me just fills a niche that is so demanded but didn't really exist before, so needed but didn't really exist before. We have, on the one hand, we have venture-backed companies, and that's what we read a lot about in the press, is companies raising large venture-backed rounds. But the reality is venture capitalists fund a very small percentage of not just companies overall, but even tech companies. They fund about 1% of tech companies get funding from venture capitalists. So even though that's what we hear about the most and that's what's celebrated the most, it's actually not the most common path for somebody growing a tech company to find growth capital. And then on the other hand, there's banks, and banks typically aren't going to lend to early stage technology companies. They're looking for profits, which a lot of times these early stage technology companies don't have because they're investing all their money into growth. And investing all their revenue back into growth. So they're seeking growth more than profits. And they're looking for hard assets, things over which they can take a secured interest. So there's this great group of companies, in fact, the majority of tech companies that, before Lighter came along and other companies now like Lighter, didn't have easy access to financing. They would have to bootstrap. So they'd have to fund it themselves or maybe get friends and family money. But Lighter fills this gap for companies for a specific type of tech company. And we look for companies that have recurring revenue, and we'll fund companies that have at least $200,000 a year in recurring revenue. And it's non-dilutive, which means we don't take any equity and we don't take any control.
Wow, that's amazing. You mentioned that it's such a needed market, and the other providers only touch a small golden goose egg of companies on the other side. But there's so many companies that need funding, whether it's to, like a client of mine, to go buy a supply that they need to produce the product that they're doing. And, it's just not available. I mean, for these smaller companies, not just tech, but all smaller companies, it's such a missing, needed space that I'm so glad Lighter fills.
Yeah.
So,
go ahead.
I was just going to say, so tell me, when we look at these kind of financing opportunities, what are some of the needs from the business owners that they're looking for that kind of financing for?
Well, typically it's for growth. So oftentimes, and we've done over 1,000 rounds of financing. So
wow,
in that we have a lot of different examples from companies that are really far along and maybe have already raised venture capital, but want to use non-dilutive funding for their next stage. But the most common company that we fund has around $1 million in revenue, annual revenue. Like I said, they only need to have 200,000, but the most common is a company that has $1 million in revenue. They've either reached that point through bootstrapping, so not taking any external capital, or a lot of times maybe some angels, some friends and family money, and they've now figured out their market. They figured out how to sell what they're selling, their products ready. So oftentimes they are looking for growth capital because they're now ready to hire, either potentially it's their first external salesperson, or they're ready to expand their product and they want to hire a few more dev people. But it oftentimes is for growth. Companies that have been bootstrapped to a certain point and they know if they pour water here, it will grow, and they're ready to go get some water.
I love that. I love that. And oftentimes, like you said, the traditional banks, they don't want that. They want something that's already solid and proven, and profitability's there, or there's hard assets that they could go repossess if they needed to.
Or personal guarantees from the founders. Yeah.
Right. Their homes, their retirement accounts, and their investment accounts, which is, a lot of times these kind of founders have put that money into their business, so they may not look really strong on paper. So having opportunities like yours opens the door for that growth. And I think that's the space we're both in, is the growing situation. So I find that it's very welcoming that there's opportunities out there like that.
Yeah, absolutely.
So when we're talking about financing, we're talking about growth. We're hiring development people. We're hiring salespeople. Maybe we're buying more product to improve the product that we're delivering, or system or software or what have you that we're doing. None of that needs to be proven or put up as collateral.
No, I mean, we take a general security over the company, but we don't take, for example, we don't secure the invoices. We don't take, it's not a factoring company. So the way the product works is we lend a fixed amount of money. So let's say we say, Marcia, we will give you $1. And if it's over 3 years, typically our loans are over 3 years, they're longer. We might say in over 3 years, depending on where you sit on the risk factor, we, take a whole bunch of data in, and where you sit and how we factor in risk. We will say, okay, you'll pay us back $1.30 over 3 years. And if you want money for a shorter time, it might be like $1.08 over a year. But typically companies want money for a longer period of time. And actually the IRR, the internal rate of return, is actually lower if you borrow $1.30 over 3 years than $1.08 over 1 year, depending on payments. But anyway, So let's take that longer term example. So we will say we'll give you $1 and you're going to pay us back $1.30 over 3 years. And what we're
Okay.
doing is we're predicting what we think your revenue will be. So we'll
Mm.
take the data from what your revenue already is, and we'll say, we think your revenue will be this over the next 3 years. And therefore, if you pay us a percentage of your revenue, and it's usually a very small percentage, 10% or under 10%, you will have paid us back in full in 3 years.
I love that.
And we
So
don't
very simple
take
math. Very simple math.
it's very simple. And what the entrepreneur has to do is look at, is that 30 cents that I'm paying going to, create more than that in value? And it's really inexpensive money compared to taking venture money or, any kind of dilutive capital from an angel. Let's say you had to give away, 10% of your company I'm saying $1, but we're saying
Sure.
$1 million, right? Let's say you had
We're
to give
we're
away
easy
10% of your
math.
company, right, to get that $1 million, and your company is going to be worth tens of millions of dollars. That ends up being really expensive if you have to go down an equity path
Very
and you're
expensive.
growing. So and then the nice thing, our payback is very much aligned with the entrepreneurs, because the payback is a percentage of your revenue, and it's a percentage of the cash collected revenue.
Mm.
So it works really well for companies. Well, it works really well for all companies, but it works especially well for companies that have seasonal revenue. So,
Mm.
if your revenue is collected 1 or 2 times a year, which, we have companies in the ed tech space where that's the case, they'll have bigger loan payments because it's a fixed percentage of the revenue. So say it's 5% of your revenue. And, 1 month you might have 200,000 in revenue, and the next month you have no revenue. So the month that you have 200,000 in revenue, it's always 5% of the revenue. So it's not an onerous debt burden that cannot be serviced because it's based on cash collected revenue.
I love it. And it seems very, very user friendly to the business owner and easily calculated by your own. So what triggered me or what caught me is the thing that venture capitalists or other lenders, the angel investors and series loans and those kind of things, is they want a piece of the company.
Yeah.
And what I guide my clients with is like, hey, wait a minute, you're giving up a piece forever. And the
Right.
only way you can get them out is to buy them out or sell the company, which a lot
Mm.
of times that's what they're pushing to do. And if that's not your path for your company, maybe it is. There's nothing wrong with that. But if that's not your path to be acquired and get out and start again, then you might want to look at how taking on that kind of money can have a long-term relationship with
Yeah.
someone that maybe you don't want a long-term relationship with.
Yeah. No, it's a very
It's
good
scary.
point. Yeah. And I've been an angel investor for a long time. I've done over 30 angel investments and been a venture capitalist for a long time. And, there's absolutely a role for those types of investors. But, like we said earlier, there's a lot of companies for whom that's just not a good fit. And especially when you take venture money, you're agreeing to sell your company. You might not be
Mm-hmm.
selling it at that point, but oftentimes you're giving up some control, and it's fundamental control. You're giving up control over oftentimes when you can take capital in the future and when you can sell your company, because a lot of times venture rounds will come with those provisions that they have, which makes sense for a venture capitalist, that they have the right to, they'll have veto rights over future rounds. So it
Sure.
is a long-term relationship, and the equity is something to be really considerate about giving away, but it's also
100%.
control and making sure that when you are taking that step, you are taking it with somebody, an investor who's perfectly aligned with your vision. I mean, the step of taking venture capital, and that you are going to sell your company, because, if I'm an
Yeah.
investor, whether it's angel or venture, I'm not putting my money in there to sit there forever. I'm expecting an exit. I'm expecting it to be at least 10 times, the price that I put it in. So, and again, I've been a venture capitalist, an angel investor. There's a, relevant, they're very relevant in this ecosystem, but it's not for
And
every
needed.
company.
we're not bad. I'm not bad mouthing VC by any means. There is a need and a purpose for them, and it's a great opportunity to get your business to the level that you want to. But that's not the only place, as you said, that's only a 1% in many companies. And the polar opposite of a VC is your local bank. Walking into National Bank of Australia or Bank of Missouri or Bank
Right.
of America and saying, "Can I get a business growth loan?" They're going to
Yeah.
laugh you out of the branch because your business isn't stacked in a way to be able to do that, and there's no real true capital or asset
Yeah.
that they can bank on.
Yeah.
So then we
It's
try to
it's
build the relationship and all that stuff, but it's they still say no more often than yes.
Well, I mean, it's why Lighter Capital exists and a lot of other alternative financing companies exist because banks who have the cheapest form, the cheapest access to capital, if banks were to go into this market, there really wouldn't be a need for companies like Lighter Capital and other alternative fintechs. But most banks, they want to see profitability, they want to see hard assets, they want to see personal guarantees.
All that
And
you
there's
don't
all
have
kinds
yet.
of reasons. I spent, close to 5 years working at National Australia Bank. There's all kinds of logical reasons for
Sure.
that, given the regulations they have to operate under. But it's typically almost never an option for the types of companies we fund. In fact, when they get to a point where they could be bank financeable, two of our biggest investors are Silicon Valley Bank and National Australia Bank. We make those introductions because
I
that will
love it.
be a cheaper form of capital than we can provide.
I love that. So one more alternative side that people hear about often is the maybe the shorter term loans, the higher interest rates. Is this something that compares to you, or are you an in between that and one of the better options? Because there's like kind of like cash loans, right? Where
Mm-hmm.
you need financing between your paychecks, and you go get a
Yeah.
cash money loan. I've seen clients use those and they're horrible. I mean, they're very expensive to do. Are you like that, or are you not like that?
No, we're longer term.
Perfect.
And I mean, I'm thinking of MCA, which is merchant cash advance, and there's companies that play in that space. And those are typically shorter term, sort of 30 days to maybe, up to 180 days. And that's where you're borrowing money and you're paying back based on your revenue. And it's usually daily revenue. So your revenue that comes in, there's a percentage of that that's going out until the loan's paid back. And those also are very useful for companies because if you think about now the interest rate's going to be very high on
Right.
those.
And I
But if
think
you
that's the hard part is that you get into this vicious cycle of I'm paying this back and and now I'm
mm,
in this whirlwind of a circle that they can't get out. But with some companies, that's the only thing they qualify for until
well,
they
yeah,
find
and
someone
it
like you.
also might make business sense. So think if you're a business and if you had another dollar, you could make $2 in the next month. If
Mm-hmm.
and another dollar to advertise or buy more
Mm-hmm.
product. And the only access you have to that dollar is something that's going to cost you a lot of money in a short amount of
50
time, but
cents.
less than $2, less than another dollar, it would make sense to get it because it gives you access to, whether it's advertising or whatever you need. But we
Right.
don't typically, we'll have some companies that want money for just a year, and we're happy to do that because frankly, there's a lot less risk. Our
Right.
risk is companies going out of business, and we do have companies
Oh,
go out of business. We lend to, early stage startups, and some of them don't make it before they've paid back our financing. So shorter term is great for us, but most companies, they're looking for growth capital. And if they have to pay it back in a year, it's just not enough time to deploy it and get that growth that
right.
they want. I mean,
Right.
imagine, you're borrowing $1 million and you're paying it back in a year, and say you're paying a million 80,000 in a year. You're making payments of close to $100,000 a month to get that paid off. And
That's hard.
that's, Yeah, you're not really having the time to invest that money and get the growth. But like I said, we're happy to do those shorter terms. It's just
Sure.
shorter term financing. It's just most companies that we work with want, we do 3 years.
As long as they
Most
can.
companies want more than that because
As long as they
it's a
can.
lower monthly payment, right? And
Yeah.
they're looking for, using that cash for growth.
Awesome. So, when a company uses Lighter Capital or somebody similar like you, and this is a perfect fit, they get the financing. This is credit building as well, right? They're showing their ability to. You report, I assume, to the credit bureau and Duns and Bradstreet. I always switch those Duns and Bradstreet. You report, right? So it's credit building as well.
They're not looking for our financing for that. They're typically looking for it for growth. But
Sure.
what we do a lot of besides providing money is there's some credibility. We're very well known in the venture capital ecosystem and in the private equity ecosystem, both in the US and in Australia. So when companies do want to go down that path, I mean, often an exit for our companies is an exit to a private equity firm.
Mm,
They know if they're a lighter back company, there's probably, it's probably worth taking a look at. And the same on the venture side. So it helps a lot with the credibility for, going down that route. In terms of just building credit to get a credit card,
no. But it does help, though. It
it's
does help because you can get a letter of recommendation from you showing that you had a good payment history. And it would help
mm,
the customer going forward as they're building and growing because
yeah.
startups are constantly looking to better strengthen their business profile. And so I was thinking, here's maybe another way that they can add more points to their credit.
Yeah. Yeah, absolutely.
Love it. Okay, so now let's dig in a little bit here about what you're looking at when you're looking at these businesses to
Mm.
show that they're good quality or good investment on your behalf. What are you looking at?
Well, the nice thing about our credit decisioning process is that it's all data driven. So, meaning we look at your data, we look at the numbers, we look at hundreds of points of data in order to come to a decision and come to a risk rating. And the application itself takes under 10 minutes if you're a slow typer, because it's a pretty short application. And then we plug into the financials, the accounting platform, and the banking platform. And that's how we make our credit decision. And it's very different than, say, how a venture capitalist or even an angel investor typically makes an investing decision. They're also looking at a lot of data, but a lot of times what they're primarily looking at is the team, and the
Mm,
team is a very subjective measurement,
right.
right? So and that's why when we look at where venture capital dollars have gone historically, it's overwhelmingly to males and overwhelmingly to white males because it's just pattern recognition, right? So what's interesting, but also not surprising, is if you look at where Lighter has deployed funds, because we don't have any subjective criteria in our underwriting process. We have the percentage that has gone to women-led companies, companies with women on their senior management team, and
Love
people
it.
of color is a lot higher than you would see in venture, and that's because we don't have those subjective measurements in place. Which there's a lot of bias and a lot of unconscious bias that goes into those decisions.
Exactly. You know what? That's a great thing to hear that you're lending to a diverse audience because you're right. I mean, you got to be part of, you got to show, you got to have all the team in place and showing. And I mean, like we had discussed before, that in venture capital, they're looking at what's your projection, right? What are we looking at? What's the business plan? How is that exit going to be formed? How are we, the venture capitalists, coming into going, how can I get 10x on my money and how soon can we get that
Mm,
back, right?
yeah.
Whereas you're looking at, hey, it's your money, you go do what you need to do, you just pay us back, right?
Exactly. It's here is the capital you need. It's very benign capital. And how else can we help you?
Oh, I love
So
that.
and some companies rely on us a lot for help. And some companies, just take the capital and don't need much else, but we're there to help if they need it. And the
Love it.
ways that we provide the most help, we have a perks program. So you get AWS credits and all kinds of discounts, but really probably what we're used for the most often is help with fundraising when they do want to go down that path.
I
So
love it.
because that's our background, we can help with their PowerPoint presentation. And most importantly, we help with warm introductions. And then another way where
That's
there's,
worth
yeah,
millions right there, right? Because
exactly.
you know the company because you're working with them and you know the perfect next partner for them, right?
Yeah, exactly. And we can't make the funding decision on behalf of the venture capitalists, but we can
Sure.
at least get them the meeting, which I know after being a venture capitalist for a long time, you really need warm intros to get those
Ah,
meeting. They're inundated. And, how do you get above the crowd and get noticed? And that's with a warm
right.
introduction. And then another
Well,
thing is we provide a lot of connectivity, or the opportunity for connectivity for our CEOs. So because we've done over 1,000 rounds of financing and financed over 500 companies, mostly in the B2B SaaS space, if there's an issue one of our current clients is dealing with, chances are someone else in our portfolio is dealing with it or has faced that challenge before, or someone who's exited our portfolio. So I have found as an entrepreneur that, I learn more from other entrepreneurs than anybody else. And so I think one of the biggest value adds we have is the connections to other entrepreneurs in our community.
I like that. Do you do a roundtable kind of mastermind where you bring them together?
We do.
Or
We
do
have a
they just,
CEO summit that
oh, perfect.
people come together for a couple days in the US. We've been doing that for a couple years. And we just had our first CEO summit in Australia because Australia is a newer market for us. And that was a day. That was actually just last week.
Oh,
And we also have CEO groups,
I love
which are very valuable. I belong to I've been involved in a CEO group for some time, and it's really valuable, and it's also expensive. You pay for it, but we provide, for the Lighter Capital CEOs, they have access to these CEO groups free of
I love it.
charge.
I love it. And another question. So you, because you're in Australia, and I know you explained you're part-time in Australia and part-time in the US, do you lend internationally? Do you lend more in the US? Where's your
Mm.
dollars going?
Yeah, Lighter Capital started in 2010 in the US.
Mm.
And so most of when I talk about those 1,000 rounds of financing, I think we've done in terms of rounds of financing somewhere between 25 and 30 in Australia and a
Oh,
few in Canada. So pretty much everything else has been done in the US. But we operate in Canada, the US, and Australia. And the US is
great.
our primary market.
Love it. And you mentioned mostly fintech or tech companies. Do you go outside of that arena, or is that kind of the lane that you guys choose and that's where you stay?
Well, we look for recurring revenue and high gross margins, and those typically tend to be technology companies.
Mm.
But we have provided capital to non-tech companies as well, as long as we can see that we have to be able to predict the revenue. That's how
Sure.
we predict, how are we going to get paid back in 3 years? We have to predict the revenue, and we're looking at the past to predict what's going to happen in the future. So typically that's companies with recurring revenue, which doesn't necessarily mean tech companies, but and with strong gross margins. So usually it's tech companies with recurring revenue, but in those 1,000 rounds of financing, we have some exceptions.
I love it. I love it. Yeah, because there's a lot of companies out there that do have recurring revenue.
Mm.
A lot of my clients, I focus on making sure that they have some sort of repeat revenue market, whether it's the financial services world where they're getting the monthly revenue for it, or they're delivering a product on a subscription model.
Mm-hmm.
These are really important pieces rather than, like you said, you get the big spikes in education and then it falls down. And then come spring, you get another big spike in education.
Yeah.
That can be
Well,
quite challenging for a business model. So having the recurring revenue is a beautiful piece.
absolutely. And in fact, a couple of our companies come to mind that you might not think are classic tech companies. One
Mm-hmm.
is Playground Sessions. That's a company that provides online piano lessons.
Oh,
And they have a partnership with Quincy Jones, and it's such a great company. And as you can
wow.
imagine, it grew a lot during COVID. Another one of our companies, Beachly, they provide a quarterly, it's a subscription product for consumers, and it's the quarterly beach basket, beach bag, things that you would
Oh,
need
how
at the beach.
fun.
It's really cool, great great growth, great customers, run by a wonderful entrepreneur, really good product. So, and another one of our companies is a dating app. It's called Datebox. So it's for couples, and it's a subscription date box where you,
Love it.
it's
A
hard
real
thinking
dating
of.
app, right? You
Well, yeah,
guys,
not a dating
you're
app
already
to
a
pair
couple.
people, but people that are already couples, to give them date ideas and provide them with everything they need.
I
And so
love
they've
it.
sort of got that date night is already pre-planned for them, everything they need for it.
Oh,
Yeah,
I
and it's
love
great.
that.
Another, so
Date
those
in a
I wouldn't,
box.
yeah, a date in a box. They're called date box. But so I wouldn't call those, your traditional tech companies, but there's recurring revenue and there's a predictive element. So we can fund companies like that.
I love that. I love that. It is so refreshing to hear that there are other financing options, because it's difficult to bootstrap. And unless you're going to go out and do some sort of crowdfunding, there's really not very many options for you
Yeah.
to get the money you need to grow, because we both agree that you need an influx of money to expand and grow and hire the people, buy the products that you need. And it's hard to do that on the back of sales,
Right.
especially in a young company. So I love the fact that you're giving these young companies an opportunity to do what they know they can do.
Yeah.
And I love it. It's more of an angel funding in my mind than angel investing would be. I think it's great. So where can people find out more about you, Lighter Capital, funding in the States, coming up with different options? I know people are looking for you out there. So where can they find you?
So we are lightercapital.com, and the pre-qualification just takes 45 seconds at the most to fill out, which kind of tells you if you might be a fit or not. Lightercapital.com/apply. And then we've also recently launched, which you can find on our website, and we can put this up on your podcast website as well, which I'm really excited about, which is a what's my valuation calculator. It's probably a question we get asked almost more often than any other question when companies are looking at, what's my company valued at? And of course, this isn't an exact, you never know what your company's valued exactly at until you go to find a buyer willing to pay that. But we're taking in external data to give a range of what companies would be valued at. And especially in this changing market, we're finding, that's a very common question that's asked.
Exactly. And they can find that just on your website, Lighter Capital. And it's lighter like the big
Lightercapital.com.
lighter, Lighter.
Lighter. Exactly.
Yeah, that's fantastic, because, when we're looking at growing our company and we want to make sure that we're doing the right things, checking the value of your company is super important, because then you know if you're doing the right thing. And then you're valuing, it's part of the data that you're using in your qualifications, is what's the value worth now? What could it be worth in the future with this
Exactly.
growth potential? And it's just another supportive data piece that business owners need to know. So thank you.
Yeah,
That's wonderful
exactly.
for that.
Especially when they go to fundraise when they go to equity fundraise or when they go to sell their company.
Exactly. So important. Well, Melissa, this has been awesome. You've shared some really good ideas, and I think you've opened up opportunities for listeners that they probably didn't know about. I mean, like you said, we all know about VC, and we all know that banks really don't want to lend to us business owners. So we were there was nothing there, and now you've brought Lighter Capital to our attention. So that's amazing.
Well, thanks for having me, Marcia. It was great to speak with you.
Yeah. All right. Great. Well, listeners, I hope you found an idea or two to put into your business that will help you be more profitable. And now more than ever, it's super important to focus on growing your business and its revenue. And by the way, capital infusion can help that business growth as well.
Mm-hmm.
So again, I'm looking for a few industry leaders and business owners to interview about my book's 12 strategies that would impact your industry. Go download my book and let me know if you'd like to be interviewed. It's available for free only for the next few weeks while I'm interviewing folks. So these strategies, again, can help any business increase their revenue, profit, and the value of their company without having to pay for additional marketing or advertising. Go pick up a copy of your book at trajectoryprofits.com/book-download. And you know what? These will help you strengthen your company as well. So when you do need that influx of funding, you're going to be in a better trajectory to get there. So Melissa and I would love to hear your questions, feedback. Tell us what you're doing for growth. Tell us what you need money for, and Melissa and I will comment on the subscription or on the podcast feed. And don't forget, while you're at it, subscribe to the podcast. And you can catch Profit with a Plan on any of your favorite podcast players. And we're looking forward to more great profitable information on next week's show. So until then, make your plans and profit with them. Thanks so much, Melissa.
Thank you, Marcia.